Today I'm going to be showing you why mastering one strategy, like the TBD system, is the key to consistency and profitability in trading. Hi, my name is Janet and this is 𝗟𝗶𝗹𝗃. If you're new here, welcome. If you're returning, welcome back. Be sure to hit that like button for the YouTube algorithm and hit subscribe if you're not already subscribed so you can be notified every time I upload a new video. Many traders fail because they constantly hop from one strategy to another, chasing what seems to work for others. The problem is they never fully understand the nuances of any one strategy, and they're always stuck in the cycle of testing and failing. Here's the thing, all strategies have losing trades. It's not about finding a strategy that never loses. It's about mastering a strategy that gives you an edge over time. Let's pull up a chart and see why traditional patterns and strategies often struggle and how the TBD system helps traders with these common pitfalls. A trader may see this pattern as a symmetrical triangle or a bullish pennant. Now, triangles can break out both ways. However, coming from an uptrend, the expectation would be that this breaks out to the upside. And if you are seeing it as a bullish pennant, then again, the expectation would be that it breaks out to the upside. Now we can see that neither of these continuation patterns played out, and instead price broke out to the downside. Now if I move across the chart and show you another example, we have a symmetrical triangle yet again, coming from an uptrend, and this one just so happened to break out to the upside. So I'm not here to tell you that retail patterns don't work. However, there is a time and place where retail patterns will play out, and it depends on where you are in the market maker's model. So this one played out, and whilst in TTC we don't trade retail patterns, we'll sometimes draw them on our charts to get an idea of what retail might be thinking and how the market maker may manipulate price action to induce traders into taking a position. Instead of trading retail patterns blindly, we take into account other key indicators like market session time and open interest. The market session times indicator shows us exactly when the major markets, Asia, UK and US, are active. These are the times when the market makers are most involved, and that's when we want to be trading. By having these sessions clearly marked, we can quickly spot when the market is likely to be slow or when the market may run a trend. It keeps everything super clear and removes any of the guesswork from our trading sessions. This indicator is always accurate, no matter whether your time zone is in daylight savings or not. So with this in mind, whilst some may have drawn this as a triangle, we in TTC would have charted it like this. We know on a typical weekend, price will consolidate into what we call the weekend trap. This is also explained in the model that we trade. Weekend trap, W or M formation, 3 rise levels, midweek reversal, followed by 3 level drops to put us back into the weekend trap. So we let price do the weekend consolidation. We come back to the charts around Sunday, 5 p.m. New York, to look for signs of false move week beginning, which on the indicator is the slightly shaded background here. By the way, you can add this indicator by coming up to indicators and typing in market session times by 𝗟𝗶𝗹𝗃, and it will add the indicator to your chart. From here, we layer in what has happened over the weekend, who was induced into taking a position out of boredom or FOMO, and this is when we look to open interest. Open interest shows us a few different things. It shows us how many traders have active positions in the market, whether traders are opening new positions or closing existing positions. When open interest increases, it means more longs and shorts are being opened, and when it decreases, it shows that traders are exiting their positions. And if it is a sharp drop in open interest, this would indicate that traders are being liquidated. When watching open interest alongside price action, we can spot when traders might be trapped, when breakouts are likely to succeed or fail, and when big moves are about to happen. You can also add this indicator by heading up to indicators, open interest, auto override, and select the one from 𝗟𝗶𝗹𝗃. So when we apply this to the chart, we can see we got a typical weekend trap where price just consolidated. When we look to the open interest, we can see that it is flat and the volume is also flat. So when price is consolidating, the volume is flat and the open interest is flat. This means that there is a stop hunt likely before a major move is made. Now the market maker achieves two things by issuing a stop hunt. Whilst price was still in the weekend trap or sideways consolidation and price was moving to the downside, open interest started to rise. This would indicate that the market maker has finally induced traders to take a position. At the same time, the stop hunt would have taken out anyone who had opened long positions over the weekend with a tight stop loss underneath the consolidation. And we can see that by open interest then declining, meaning traders are closing their positions. So the two things were, he induced retail to take a position short, stopped out those who had opened longs during the weekend, and it has happened around Sunday, 5 p.m. New York, which is when we come back to the charts. Now that we can see what market maker has achieved over the weekend and the stop hunt that was issued around market open, we look for a reversal pattern from here. So we have the first side of a potential W formation. Ideally, we would want the second side of the W formation to form in another session or day. In this case, we got it in another session. In this example, there were two trade entries that presented according to the model we trade. Regardless of which one you took, both would have played out. By trading at the right time, we avoid fakeouts and stop hunts and increase our winning probability. If you need an exchange to trade on, consider checking out Bitunix. It is no KYC and no VPN required, so you should be able to get access to this one worldwide. You can also trade spot and futures. They also have a mobile phone app, so you can check on your trades or the market anytime and anywhere. If you use the link in the description to create your very own Bitunix account, you'll get a 20% trading fee rebate on all your trades for life. Trading fees really do add up over time as your account grows. So you need to be looking for ways to minimize those fees on trades so you can keep more of the profit. So be sure to use the exclusive link down in the description below. Now here's an example of a breakout trade that played out perfectly if you are a breakout trader. If you are a great trader and had to take profit at the next support level or spotted a reversal pattern and exited your trade, then this one played out beautifully. However, if you didn't, then this beautiful setup completely reversed on you. Now let me show you how we would have traded it in TTC. We've just learned that over the weekend price typically goes into consolidation, which is what we call the weekend trap. We've also just learned about market session times and that we in TTC come back to the charts around Sunday 5 p.m. New York to assess what the market maker has achieved over the weekend. We know that price has gone into consolidation, giving us a typical weekend trap. We can also see that the volume is super flat, and when we look at open interest, we can see it has increased during this price action over the weekend. So when we have sideways price action or consolidation, low volume and open interest increasing, this means stop hunt not necessary, breakout incoming. So now that we're back at the charts and we have assessed price action, open interest, and the volume, we know that a breakout is coming. So the entry for the TTC community would have been in here, essentially giving us an M formation. Because we're aware of false move week beginning, we treat this trade as a day trade before looking for a reversal pattern to bag flip it the other way, which essentially means we hold our trade open until we get our 3 levels or a reversal pattern, which is our sign to exit. We have a multi-session W formation from Asia into UK, so we take profits on that short and open a long. Now we hold this trade for 3 levels or the 3-day swing until we get our reversal pattern and an exit. So here we have our rise level 1, rise level 2, rise level 3, on day 3, reversal pattern, a multi-day, multi-session M formation, and close on this candle here if you hadn't already taken profits. Again, all of this comes back to the model we trade. Fakeouts happen all the time and traders fall for them because they don't understand market session times or open interest. So let me show you another example of how the TBD system can help you to avoid fakeouts. We can see this consolidation or range formed near a key resistance level. Not only was it a key level we watch in TTC, if I zoom out, we can see that retail would have had a resistance level drawn in this area also. Whilst price is consolidating, market maker is accumulating contract whilst trying to bore retail into picking a direction. This helps them to build their own positions and build liquidity before they shift price in the intended direction. So whilst price was in consolidation, open interest was decreasing whilst the volume was flat. This means stop hunt likely before a major move is made. The stop hunt is designed to get retail to commit to a position, so whilst this candle was open, it would have looked like a big green candle, and for those that don't wait for the candle to close or have buy stops above price expecting this to be the big breakout, then it triggers those long orders. At the same time, it triggers stop losses of anyone who opened shorts within this boardroom. So this is where we see the breakout of the consolidation or range and a break of that major resistance level. Then we look at open interest and it starts to increase, meaning the market maker has accomplished their goal by inducing retail to take a position. Now for us who trade the TBD system, we were waiting for that to happen because we understand the open interest, the volume, and reading price action. We also know that that consolidation was coming off 3 level rises and the 3-day swing. So we were looking for a multi-session M to short it back the other way. So here we have a multi-session M from UK into US. And I also gave the community a heads up on that with this chart update here from the 20th of February. The short off the high of the week is the one I'm waiting for, as I believe it could be the short that gives us drop level 3 for the 4-hour time frame, e.g. the Linda short. And here is that chart. If you want to learn all of this in detail, consider grabbing yourself a TTC membership. Inside of our memberships, we have full trading courses so you can learn all of this in detail, multiple live sessions daily from our pro traders so you're never trading alone, a private community of serious traders who are winning together, and exclusive indicators to help you make smarter entries and exits. So if you're serious about trading, consider grabbing yourself a membership with the link in the description. So let's head back to that symmetrical triangle or bullish pennant from the start of the video. We already know that this one didn't play out as some traders would have expected. And you might be wondering, did we in TTC see the reversal before it happened? Were we looking for long positions or short positions? Were there hints of this symmetrical triangle breaking to the downside? And were there indicators that could have helped us? And the biggest question, why didn't this symmetrical triangle or bullish pennant play out as expected? Let's start with question 1. Did we in TTC see the reversal before it happened? Yes. This comes back to the model we trade. We can identify that the damage happened late US session, which actually gave us another type of reversal pattern, which is a trapping volume formation. From our trapping volume formation, we got our 3 levels of rises, our 3-day swing. We then got our bearish candlestick pattern, which is a bearish engulfing that also came with a large wick to the upside, giving us our trapped traders zone. So were we looking for longs? No. Were we looking for shorts? Yes. Now let's answer the next question. Were there hints of this symmetrical triangle breaking to the downside? And the answer is yes. Besides the fact of this being at level 3 of the model we trade, if you take into account what we've just learned about open interest, you too would have got the heads up that this pattern was about to fail and reverse to the downside. So let's dissect that. Now before the symmetrical triangle had even formed, no one can know that it's going to form a symmetrical triangle because we need more price action. What was clear to us in TTC is that we had our 3-day swing or 3 levels of rises. We had our first bearish candlestick pattern to slam the brakes on and stop price moving to the upside. What we need now is one of our many reversal patterns to then exit the long and flip short. And we didn't have that yet. And instead, price went into sideways consolidation. Now for us in TTC, we know that when price goes into consolidation, which is what we call a boardroom, This is the market maker accumulating contracts and building their positions before they shift price out. So we let price consolidate and use our indicators to help us anticipate where the market maker is going to send it next. And lucky for you guys, we've already been learning about open interest and market session times. So let's go through and dissect how we in TTC would have traded this before I go through and answer the last question, which is why didn't this symmetrical triangle coming from an uptrend or bullish pennant play out and instead failed? Now I've already gone through and shown you the reversal pattern, the weekend trap, and our 3 levels of rises 3-day swing. I've talked about our first bearish candlestick pattern, which was stopping price moving to the upside, working like a stopping volume candle. So now that we have all of this and price has now gone back into consolidation, ideally what I am looking for is reasons to open a short. So I'm going to drop down to the 15-minute time frame, just so we can see things a lot clearer. First of all, I'm going to bring up open interest and see what has been happening. Now I can already see that open interest was increasing whilst price was moving to the upside here. We already know that when open interest increases, this means that people are opening shorts and longs, but we also know that market maker is filling the other side of retail trades. So if price was moving up, I am going to make the assumption that retail have opened long positions and the market maker is slowly filling the other side of their trades. From there, price went into the boardroom or sideways consolidation. So I also want to assess the open interest whilst price was in the sideways consolidation. So I can already see during this little bit of price action that positions were being opened because of the open interest increase. And then when price was brought back down, people started to close positions. This red open interest candle shows me that whilst the candle was open, people were opening position, but at the same time, people got liquidated. And then from there, open interest started to increase. So I'm going to assume that whilst these candles were pushing up, people were opening long positions. Open interest then flattens out and then it starts to increase again on the up move. So market makers inducing people to take long position. Then we move further across to these 2 green candles and we finally get another spike in open interest, trapping more long. So whilst price was in this boardroom, I can see that whenever open interest started to increase, that price was moving to the upside and people were getting induced to opening long positions. Now, I had already pointed out that we were at rise level 3 after the 3-day swing. I also pointed out that we have trapped traders above price, and if we are to follow the model we trade, I should be looking for a reversal pattern to get the next 3-day swing to the downside. There are some key levels that aren't marked out anymore, but this candle here is called the initial high of the day. When price spiked to the upside, we did not break the initial high of the day. We then got a bearish candlestick pattern, essentially giving us a multi-session M from the dead gap zone, which is the shaded background, into the UK session. We also have trapped traders to the upside, and how the trapped traders works is whilst price was moving to the upside in this green candle, traders would have opened long positions. Not you guys, you're too good for that, before price then slammed back down, trapping anyone who went long. And now they are waiting to get out at break even. And again, we see it in open interest. When price started to rise, our open interest started to increase. Again, the same thing. Traders were opening longs. We then got a bearish candlestick pattern here, trapping anyone who went long in this green candle. Price went into consolidation. Again, one more time, open interest started to increase whilst these 2 green candles were moving to the upside, and then bang, brought straight back down with a bearish engulfing, trapping anyone who went long in here. So what you can see is price never returned back into this trap traders zone to release anyone who went long. Same with this bearish candlestick pattern here. Price returned into that area, but immediately got bought straight back down. So think about it. If you were a trader and you had opened a long in here, would you have exited when you seen price moving to the upside like this? I'll let you answer that. So If you weren't fast enough to close your long position and get out at break even, then price was immediately brought back down and now you're still trapped. From there, we can see price fell out dramatically. So the entry for us in TTC was this bearish candlestick pattern, which was the second side of the M formation. We can see price didn't break the initial high of the day, all of the other reasons that I told you about trap traders, sideways consolidation, coupled with open interest, everything pointing towards this is going to fail and break to the downside. So now it's time to answer the last question, which was, why didn't the symmetrical triangle or bullish pennant play out and instead failed? Now I actually run 3 live calls per week and do chart updates to follow those calls. I know I had a session in here at the end of the UK session, Thursday the 31st of October, the 31st of the 10th, which is October 2024. I have the 1 hour and 15 minute at rise level 3. We also have a symmetrical triangle, but where are symmetrical triangles less likely to play out? Level 3. In regards to pattern timing levels, midweek reversal makes sense, and this is the chart update after the live session that we took near the end of the UK session. Now what if you don't stick to one strategy? Let's play this out. Say you take 5 trades in a row using one system, but after 2 losses, you decide to abandon that strategy. You then trade another strategy and take another 2 losses, then switch again. You repeat this cycle over and over, and before you know it, you've taken 20 trades over 5 different strategies, and you still have no idea what's working. If you just stuck to one strategy and learned its nuances, you would have been able to spot why those first losses happened, what adjustments you needed to make, and how to capitalize on the next opportunity. But instead, you're back at square one. And that's why most traders fail, because they never actually give themselves the chance to actually master one strategy. A lot of traders believe that if a strategy isn't working immediately, it's broken. But the truth is, no strategy wins 100% of the time. The market is always changing, but that doesn't mean your strategy has to. Instead of switching systems, you should focus on adapting within the strategy you already trade. The TBD system is designed to work across many market conditions, trending, ranging, or consolidating. The key is learning how to adjust your execution, not throwing out your entire system after a couple of losses. Because let's be real, trading isn't easy, but if it was, everyone would be doing it. Another reason why most traders fail isn't because they don't know enough, it's because they know too much of the wrong things. They overcomplicate their charts, jump from strategy to strategy, and let emotions dictate their trades. Think about it, how many times have you hesitated to enter a trade because you were afraid of losing? Or revenge trade straight after a loss? Or got stopped out and immediately thought, maybe I should try a new indicator. These are the things that keep traders stuck. But the traders who actually make it, they know their strategy inside out. They don't need to second guess themselves. That's why sticking to one system is so important. It eliminates the guesswork. Instead of constantly wondering whether you should enter a trade, you already know the answer because you've seen it play out hundreds of times. That's what makes you confident, and that's what makes you profitable. So if you're still on the fence about sticking to one strategy, here's a challenge for you. Take just 10 trades using one system. No switching, no tweaking, no overthinking. Just follow the rules exactly as they are for just 10 trades. Write down your entries, your exits, and how you felt during that trade. At the end of those 10 trades, look at your results and ask yourself these questions. Did you follow the system? Did you follow the rules? And did you see improvements? I guarantee that if you stick to one strategy, even just for those 10 trades, you'll start to see the bigger picture of how it works. And if you're ready to go even deeper, you know where to find the full breakdown of the TBD system.